This week we had a mix of good news and curveballs, but overall it was a pretty good week. And we could start with inflation. The CPI report for May came in softer than expected. That's the inflation you see at grocery stores. Core inflation is still higher, but it's moving at its slowest pace since we saw a spike back in 2021. And rent growth, which is one of the biggest drivers of inflation, showed the lowest increase in 4 years. PPI, that's the producer price index, also came in soft, and that's really important because it feeds into the Fed's favorite measure of inflation, PCE. And we're going to get that number at the end of the month. And you might be wondering why tariffs didn't lead to higher inflation numbers. And for now, it looks like many businesses are just eating the cost for now. And it is possible that if they are raising prices, they're just not showing up in the numbers yet. And we'll just have to see if that continues. Real time, though, core inflation, with adjust for the shelter lag I've been talking about, is actually sitting around 1.7%. But unfortunately, the Fed's looking at lagging numbers still. Unemployment numbers also showed weakness in the economy, and that should be good for mortgage rates. We saw almost 250,000 initial claims, and continuing claims rose again, and both are at really high levels. Basically, more people are losing jobs, and they're struggling to find new ones. And keep in mind, first businesses will slow their hiring, then they cut hours or pay, and when they have to, they'll let people go. We are seeing these layoffs already, so, usually bad economic news is actually good for mortgage bonds, but we had a surprise last night with Israel launching the attack on Iran, and they were targeting military and nuclear sites, and this kind of spooked the markets, because they're scared that oil prices might go up, and in turn that's inflationary, and this hurt the stock market too. But unlike usual, there wasn't what they call a flight to safety, which basically helps mortgage bonds. And the good news is, though, oil production facilities weren't hit, at least not yet. And if that changes, we could see those oil prices spike, which could push inflation higher. Not good for mortgage rates. The tariff tension has kind of calmed. No deals in place yet, but they did say a framework set. The president still have to sign off on that, though. We also saw some more chatter about Fed leadership. Powell's term isn't actually up until the middle of 2026, but names like Scott Bessent and Kevin Warsh are already being floated as replacements. Meanwhile, the Fed Governor Michelle Bowman has been pushing for a deregulation change that would allow banks to hold more treasuries without restricting lending, which I explained in last week's update. And if that goes through, it would be great for rates. But looking ahead, we've got the Fed meeting next week along with retail sales, and nobody's expecting a cut just yet. But if Powell gives even a slightly more dovish tone at the press conference, we could see improvement in rate sheets. But I'll be back next week or on Friday to tell you how the Fed meeting goes and what it means for rates, along with any other market moving news we get. Take care.